In 2025, the gulf between what's being built and what people can actually afford has never been wider. New housing data shows that luxury units make up nearly 80% of all new construction, while affordable housing starts have stalled at just 150,000 units a year. This is happening even as the country faces a shortage of more than 4.5 million homes, pushing rents higher across the board and putting basic living out of reach for many. The impact is clear in the numbers. 40% of new luxury apartments are vacant 6 months after completion, yet 60% of renters now spend over half their income just to keep a roof over their heads. The economics behind this imbalance explain why the crisis keeps deepening. The 2025 luxury construction boom. Across the country, the construction landscape in 2025 is defined by a surge in luxury housing. According to the latest NAB survey, high-end units now account for about 65% of all new residential construction, a dramatic increase from just a few years ago. In 2024 alone, developers completed 1.2 million luxury rental units, a figure that dwarfs the output of affordable housing, which has stalled at roughly 150,000 units per year since 2020. This disparity stands out even more when you consider that the cost of construction materials has stabilized since the pandemic. The National Builders Organization reports that lumber prices have dropped significantly since their 2021 peak, and concrete costs have remained steady since 2023. The shift toward luxury isn't about materials or supply chains anymore. It's about where developers can maximize returns. This focus on high-end properties has created a backlog of empty units at the top of the market. CoStar Group data from early 2024 shows that luxury apartment vacancies have risen sharply in major metros like Austin and Miami. In Austin, for example, more than half of the new luxury units built since 2023 remain unleased, the highest vacancy rate in the country. Yet, construction continues at a rapid pace, with developers breaking ground on dozens of new high-end towers. Meanwhile, 60% of American renters now spend over half their income on housing, according to the Harvard Joint Center for Housing Studies. The mismatch is clear. Most new homes are built for a small, affluent segment, while the majority struggle to afford basic shelter. Regional differences make the imbalance even more apparent. In Miami, luxury developments make up 91% of new construction, even though the city faces a shortage of nearly 50,000 affordable rental units. Phoenix follows a similar pattern, with luxury projects accounting for 84% of new builds despite having one of the nation's highest rent burden rates. These construction trends are disconnected from local needs, as the vast majority of new supply targets a market segment that's already overserved. The process of building luxury housing adds further complications. High-rise luxury towers require more time and resources to complete compared to simpler mid-rise or affordable projects, largely due to elaborate amenities and complex financing arrangements. This means developers spend more time and money on each unit, but the result is not more housing for those who need it most. Instead, the focus on high-end finishes and amenities, like rooftop pools, concierge services, and premium appliances, diverts resources away from efficient, large-scale, affordable construction. The financing structure behind these projects also shapes what gets built. Banks and lenders view luxury developments as safer bets, often offering construction loans at lower interest rates than those available for affordable housing. This dynamic creates a cycle where developers are pushed to pursue luxury projects, reinforcing the trend and making it even harder to shift focus toward affordable units. In addition, the labor force has adapted to this demand, with many new construction jobs specializing in high-end finishes rather than the skills needed for efficient, cost-effective building. Material allocation reflects these priorities as well. Luxury projects consume the majority of high-end appliances and fixtures produced each year, leaving affordable housing developers to compete for what's left. Manufacturers like Sub-Zero now report selling more premium refrigerators to apartment developers than to individual homeowners, a sign of just how much the market has shifted. The concentration of luxury construction in a handful of metro areas further deepens regional divides. Just 15 cities account for nearly 70% of all high-end housing starts, while smaller cities and rural areas see little new inventory of any kind. Zoning policies reinforce this pattern, with cities like Los Angeles reserving most of their high-density development for luxury corridors, while maintaining restrictive limits elsewhere. The effects extend beyond the housing market. Cities with the highest rates of luxury construction are also seeing the fastest increases in homelessness, according to recent HUD data. This is not just a matter of misplaced priorities. It's a system that rewards prestige and profit over meeting the basic needs of the population. All of these factors point to a construction boom that is out of sync with what most Americans actually need. The reasons for this skewed focus are rooted in the financial logic that guides every development decision. Why developers won't build affordable? Developers gravitate toward luxury construction for one main reason. It's simply more profitable. According to the National Low-Income Housing Coalition, profit margins on luxury apartments consistently outpace those on affordable units by a factor of at least 2 to 1, even though the underlying construction costs are nearly identical. The difference comes down to rents. Luxury units command $3,200 a month, while affordable units average around $900. For developers and their investors, these higher returns make luxury projects the obvious choice, regardless of the broader demand for affordable homes. Policy frameworks often reinforce this preference. In most cities, zoning rules and incentives are structured in ways that make luxury development more attractive. Take Minneapolis as an example. Their formula allows developers to build up to 45% more units if they include a certain percentage of affordable housing. But in many other cities, density bonuses and building rights are more often tied to luxury amenities than affordability. This means that, in practice, developers gain extra square footage for adding rooftop pools or gyms, while affordable projects face more restrictions and fewer incentives. Tax policy adds another layer of complexity. New home construction faces an average tariff of $10,900 per unit, according to Investopedia, which developers often offset by building high-rent properties. While affordable projects can access programs like the Low-Income Housing Tax Credit, these are limited in scope, highly competitive, and require navigating complex application processes. In contrast, market-rate and luxury projects benefit from a range of deductions and credits that, while not exclusive, are easier to access and can significantly reduce effective tax burdens. The result is a system where it's far more straightforward and lucrative to build at the top of the market. Financing is another major hurdle for affordable housing. NAB Builder surveys show that banks and lenders typically offer more lenient terms for market rate and luxury projects. For example, luxury developments often need to pre-lease only 40% of their units before securing construction loans, while affordable projects must secure commitments for 70% or more. This reflects a perception that luxury tenants are more reliable, even though luxury buildings often take longer to fill. Additionally, luxury project loans frequently allow developers to delay principal payments until after lease-up, while affordable housing loans require immediate amortization, putting extra pressure on cash flow from day one. Soft costs, such as permitting delays, legal fees, and impact assessments, can consume up to a third of a project's budget, regardless of whether it's luxury or affordable. These expenses are unavoidable, but luxury's higher margins make them easier to absorb. When cities streamline approval processes, as Minneapolis did, affordable housing construction rises sharply, not because materials are cheaper, but because developers can better manage these overheads. Land acquisition further tips the scales toward luxury. When developers compete for urban sites, the projected income from luxury rents allows them to bid higher and outmaneuver affordable housing proposals. Once a luxury project sets a new price benchmark for a neighborhood, subsequent land deals become even more expensive, crowding out affordable options and making it harder to reverse the trend. Investor behavior reinforces these patterns. Most large developments rely on capital from real estate investment trusts, which segment their portfolios by expected returns. Luxury apartments are categorized as growth assets, promising double-digit returns, while affordable housing is seen as a stable, low-yield investment. This segmentation ensures that capital continues to flow toward high-end projects, even as affordable housing needs go unmet. Other operational factors, like insurance and labor, add to the imbalance. Luxury buildings typically secure lower insurance premiums, based on assumptions about tenant profiles, while affordable projects face higher rates tied to location and income levels. Labor costs also skew higher for luxury construction, as specialized tradespeople command premium wages for installing high-end finishes, leaving fewer resources for affordable projects. Material suppliers prioritize luxury orders as well, allocating the majority of premium appliances and fixtures to high-rent developments. This creates delays in hire. Costs for affordable builders, who may wait months for standard models or pay inflated prices on secondary markets. These overlapping incentives and barriers explain why developers rarely choose to build affordable housing, even in the face of overwhelming demand. The system is structured so that the safest and most profitable path leads to more luxury units. As a result, even when luxury buildings start to see rising vacancies, developers and property managers remain focused on protecting their returns, setting the stage for a new set of financial strategies that shape the rental market. The vacancy paradox. The vacancy paradox is one of the most persistent features of today's luxury housing market. Rather than lowering rents to fill empty units, property managers often keep prices high and accept significant vacancies. The reason lies in how these buildings are valued. Investors and lenders use the capitalization rate, net operating income divided by purchase price, to determine a property's worth. For example, a $10 million building generating $500,000 in annual rent would have a 5% cap rate. But if the building sets asking rents high enough to suggest it could collect $600,000, on paper its value rises to $12 million, even if many units remain empty. This approach rewards owners for maintaining elevated prices, not for maximizing occupancy. Short-term rent concessions are another tool that helps preserve this illusion. Instead of reducing the official rent, property managers offer incentives like 2 months free on a year-long lease. This keeps the headline rent high for valuation purposes, while temporarily attracting tenants. According to CoStar data, these strategies increased occupancy rates by 17% in early 2025, but once the concessions expired, vacancy rates quickly climbed again. The practice allows developers to avoid permanent price drops, which would lower the building's appraised value and potentially reduce access to financing. The effects extend beyond new buildings. Older apartment complexes in the same neighborhoods often follow suit, keeping their own rents high to avoid appearing less valuable by comparison. JLL research found that in areas with a large share of luxury development, average rents for older properties rise by over 20% due to this anchoring effect. As a result, the entire rental market drifts away from what most residents can afford. The structure of commercial real estate finance amplifies the vacancy paradox. Many luxury buildings are financed through mortgage-backed securities that rely on projected, not actual, rental income. If landlords lower rents to fill units, they risk violating loan covenants or hurting the refinancing prospects for other properties in the same portfolio. This creates a powerful incentive to keep asking rents high, even as vacancies mount. The numbers illustrate just how much is at stake. In Atlanta's Buckhead district, more than 2,000 luxury apartments sat empty in the second quarter of 2025, while the city's overall vacancy rate for all housing was just 3.4%. These unused units could have housed thousands of people, but instead remained locked up to protect paper valuations. Institutional landlords add another layer of complexity. Large firms use pricing algorithms that benchmark rents against other high-end markets, sometimes ignoring local income levels entirely. A luxury tower in Phoenix, for example, might set rents based on Manhattan prices simply because the software finds similar building features. This disconnect can lead to persistent vacancies and a rental market that serves only a narrow segment. Tax strategies also play a role. Some owners keep a portion of their units vacant to generate paper losses, which can offset income from other properties and reduce their overall tax burden. In these cases, the financial benefit of empty apartments can outweigh the revenue from additional tenants. These practices aren't limited to major cities. In places like Nashville, investor reports claim high lease rates for new luxury buildings, but utility records show that actual occupancy is often much lower. Without requirements for independent audits, the gap between reported and real occupancy can persist for years. For tenants, the vacancy paradox means higher costs. Those who do rent in luxury buildings absorb the expenses of empty units through higher fees for amenities, security, and maintenance. The result is a rental market where affordability declines, vacancies persist, and supply fails to meet genuine demand. While these financial mechanisms keep the luxury market afloat on paper, They mask deeper issues that aren't visible in glossy brochures or online listings.